Hi everyone, welcome to Option Strategies. In this video, I want to talk about how I plan to trade Occidental Petroleum with option. So why do I choose Occidental Petroleum? On August 8, 2022, a SEC filing by Berkshire Hathaway showed that the company increased its share of Occidental Petroleum to 20%. In total, Berkshire Hathaway hold 188 million shares, 10 billion preferred stock, and 83.9 million warrant of Occidental Petroleum. When the news about Berkshire Hathaway getting into Occidental Petroleum broke around the beginning of March 2022, the stock had a big jump and has trading up since. So should I jump in and buy Occidental Petroleum stock now? Instead of outright buying the stock, I can use option to give me some advantage. Now, let's look at the option strategy that I can use to trade Occidental Petroleum moving upward. The first strategy is selling a put. This is a profit or loss profile for the selling a put option strategy. The strategy is set up by selling an out-of-the-money put option. The premium that I collect from selling the put allows some buffer room for the trade. I'm able to make a profit if Occidental Petroleum stock price moving up, sideways, or even slightly down, as long as it does not move below the strike price of the put option that I sold minus the premium I collected. However, the high probability of winning limit the maximum profit that I can make from this strategy to just the premium that I collected. If the stock price drops below the strike price when the option contract expires, I will have to buy 100 shares of the stock at the strike price. Even though this may seem like a loss on the trade, but if look from different standpoint, I get to buy the stock at a lower price than it currently traded. I can avoid the obligation to buy the stock if the stock price drops by selling a vertical put spread instead of naked put option. Next option strategy that I can use is cover call. This is a profit or loss profile for the selling a cover call strategy. Cover call is set up by buying 100 shares of the stock and selling an out-of-the-money call. Cover call strategy limit the profit that I can earn. However, the maximum rewards tend to be higher than selling a naked put. Also similar to selling put option strategy, cover call strategy allow me to make profit if Occidental Petroleum stock price moving up, sideways, or even slightly down. Cover call strategy carries the risk of losing all the money that I invest in the stock because I own the stock and the stock price can drop to zero even after the short call option expired. Cover call allow me to buy the stock at a discount with the premium that I collect from selling the call option. The third option strategy that I can use is selling a combination of a put option and a vertical call spread. The strategy is set up by selling a put option and a vertical call spread by collecting total premium that is more than the width of the short vertical call spread. In this example, the collection should be more than $1. This strategy has a neutral outlook on the stock price movement before the option contract expired. The strategy has quite high probability of winning in exchange of a very limited profit. Similar to short put strategy, I'm obligated to buy the stock if the stock price drops below the strike price when the option contract expired. The last option strategy that I consider is long broken wing call butterfly. This is a profit or loss profile for buying a broken wing call butterfly option strategy. The strategy is set up by selling two at-the-money call option, buying an in-the-money call option, and buying an out-of-the-money call option. The wing of the in-the-money call vertical spread is wider than the out-of-the-money call vertical spread that collect total premium wider than out-of-the-money call vertical spread. As a result, the strategy has no upside risk. This strategy allows me to make profit if the stock price moving up, sideways, or even down. The long broken wing call butterfly strategy does limit the reward that I can profit, but it also limits the risk that I am taking. Why I do not consider buying a call option to trade the bullish move? Because I do not consider buying the call option because the it required the stock to increase more than the premium that I pay for to make the profit, which is not likely after the stock already has quite an up move since Berkshire Hathaway start invest in the company. Thank you for watching, and remember, all trade examples discussed in this video are not trade recommendation.